Hi, my name is Susan Combs and I'm an insurance broker for Combs & Company. Why are diabetics denied health insurance? So diabetes is considered a high-risk disease. It's something that either you're going to be a high utilizer now with the health insurance or you're eventually going to become a high utilizer. But either way, it's going to happen. So either whether you might have insulin that you have to take on a daily basis, or say you've had to have amputations or things like that, the insurance companies are anticipating a high amount of claims. So, so you'll get some carriers that'll actually deny you. The thing you want to look at is if you're employable, you want to try to get on a group plan because maybe they have some exclusions if you haven't had health insurance in the past that they won't cover you for say 12 months, but after you've had a continual health insurance plan in place and you haven't had a gap of more than 63 days in 12 months, then in the future they'll actually cover you. You can also take a look, some states actually have high risk pools, so for people that have diabetes, they can take a look at being insured there. The one thing that is good news that's coming down the pike is in 2014, all pre-existing conditions are going to be included. So, you know, I know that we're a few months out still and you just kind of got to hang on. But as soon as 2014 runs around, comes around, then you're not going to have to worry about being denied by any insurance company.
We're talking about high deductibles and math today. Who put this video together? So I'm going to be talking about two things that you probably don't want to talk about. One, high deductibles with your health insurance, and two, math. Nobody likes math. Nobody likes high deductibles. But stick around. I absolutely promise you're going to want to hear this. How's it going, everyone? I'm Joey Gingola with Gingola Insurance. And on this week's health insurance break, I thought, well, let's talk about high deductibles and why you may actually want them. I've been presenting this little formula to clients for some time now and people that have talked to me about their health insurance to kind of help justify wanting a higher deductible. And every time I lay this out, this simple math equation, it kind of blows their mind and makes them turn a cartwheel and welcome this high deductible with open arms. Now with Ohio's health insurance marketplace open, I'm using that term loosely, and the new plans for the Affordable Care Act available, again, loosely using that term, you're going to see that a lot of them have higher deductibles and out-of-pocket maximums than you may be used to. This would then lead you to make a difficult decision of possibly considering a higher deductible. Well, don't worry, I'm going to show you how to do the addition and subtraction, the multiplication and long division to actually help you make it make sense and help you know without a doubt that it is a smart move for your health insurance. So this very, very simple formula, and I'll show it to you right here, you're going to take your current health insurance policy and you're going to multiply that current rate times 12. That's going to give you the total annual cost of your health insurance. Yes, that number is potentially very depressing, but don't worry, after you get over that just a few seconds, it will all start to come together and be a little clearer for you. Then you're going to take the cost of that new policy with the higher deductible that you are considering. You're going to also multiply that by 12 to give you that total annual premium or payment. You're going to take those two numbers and you're going to subtract them. This is going to give you the total savings that you experience for going with the higher deductible. Now you want to take the difference between the deductibles. Let's say your family has a $5,000 deductible and you're considering going up to a $10,000 deductible. Well, that's easy math. So $5,000 is the difference there. So you're going to take that $5,000 and subtract it from the difference or that savings that you're going to experience. The difference in deductible minus the total savings is going to give you the money that is on the table. How much money of your own money is going to be at risk that you could potentially spend additionally if you do run into that worst case scenario. Now, if you want to know, and if the number's higher than what you maybe are comfortable with, and you want to get a little extra fancy with it, go ahead and take that total savings number and multiply it by 5. That's going to give you the total amount of money that you would save over a 5-year period to potentially cover your deductible. A few questions that you'll want to ask yourself is, first, have you ever met your deductible? If the answer is no, well then this should be absolutely a no-brainer procedure for you. You should run all day long to the higher deductible, assuming this math works out in any sort of fashion for you. If the answer is yes, well, then you're going to want to ask yourself, how many times in the last 5 years have you met your deductible? Well, if you answered 2, 3, or 4, or all 5, well, then chances are you might require a little more specific math to get to the bottom of your situation. And if you want a specific example, I went ahead and did this for my family of 4, for me, my wife, and my 2 kids, and I compared Medical Mutual's health savings account plans. Now, these are current health savings account plans, not new plans that are going to be offered under the Affordable Care Act with Medical Mutual. I took their $5,000 family deductible, which was $480.54 a month, and I compared it to their $10,000 family deductible, which is $307.79 a month. So if we were to get the annual cost of the $5,000 deductible, we would take $480.54 and multiply that by 12 to give us a grand total of $5,766.48. For the $10,000 deductible, that annual cost would come to $3,693.48. So we then go ahead and subtract the $5,766 from the $3,693, which gives us a total savings of $2,073 each year. Now, the difference in the deductible obviously is $5,000. So then we have a total at-risk cost of $2,927 of my own money that would be on the table, assuming me or my family would run into that full $10,000 deductible. Now, the concept behind here is I would much rather you put that extra money in your pocket than guaranteeing it to Medical Mutual. Because that's all you're basically doing when you're buying a lower deductible, is guaranteeing to pay that money for a just-in-case scenario. Otherwise, you're going to be able to hold on to that money, use it if you need it. If you don't, well, then that's money in your pocket at the end of the year. If we wanted to figure out how long it would take me to reach the amount of money that would cover that full deductible, not even the difference, just the full deductible, if I went ahead and took that $2,073 and multiplied it by 5, you'd see that I would accumulate $10,365 over a 5-year period. Well, what's the bottom line in all this? Well, you can go ahead and pay that extra amount of money every year. Medical Mutual or whichever insurance company will be happy to take it. However, I would just encourage you to look very closely at your past medical treatment and costs before you just randomly or just assume that having a low deductible is the smart and wise thing to do. So if you want to find out how this is going to relate to Ohio's health insurance marketplace and see the new plans that insurance companies have rolled out, well, go ahead and download this very free guide, How to Understand Ohio's Health Insurance Marketplace. I wrote it to help give you the best information that I can right now to understand these marketplaces, what they are, what they do for you, and how they can potentially help you save money. So go ahead, click the cover of this ebook right here to download that guide, or you can grab the link below in the video's description. So, but of course, I do want to thank you for taking the time to watch this video. It means a lot to me. I appreciate you taking the first step in helping to understand your health insurance needs. So, but of course, as always, I am Joey Gingola with Gingola Insurance. Take it easy, everyone.